Well, good evening, everyone. Welcome back to the channel. So, we have quite a bit to discuss this evening. The market seems to be off to a great start in 2023. Let's just hope it lasts. The new CPI number, or as some people call it, CPI, came out today. And inflation, some people are actually rejoicing because inflation came in at 6.5%, which is down from its 9.1% peak. But we still have a ways to go. But we're moving in a positive direction. Now let me go to Yahoo Finance because I want to go over the so far bullish trend that the market is on to start the year 2023, which is very encouraging. Now, for me personally, I have a rule of thumb that it seems like odd years are better for me personally than even years. I don't know why that is. I do have even years that are very accomplished, like last year. But for some reason, it just seems like odd numbered years just go better for whatever reason. So, what I want to discuss, coincidentally, three of the funds I want to discuss happen to be at the bottom of the screen here. And all of them are doing really well so far. So, if you had bought into these funds basically on the first trading day of the year 2023, you would be doing very nicely. Now, as far as the three major indexes, well, I guess we can go over the Dow, which I mean, we still talk about the Dow, but the Dow is, as we know, those of us who, follow this channel frequently, I discuss this a lot. The Dow is not representative of the overall market, but yet we still talk about it. So, but, just for the heck of it, we'll go over it here. So the Dow has gained over 1,000 points actually to start the year 2023. But again, it's 30 blue chip companies, not really representative of the overall market like the S&P is. The NASDAQ to start the year has gained about 440 something points. And the S&P, which is actually representative of the overall market, has gained about it's gained about 140 something. And there's that colorful Fidelity ad again, because we were talking about Fidelity the other day. Well, I'm in three mutual funds there that are free. But anyway, so the S&P has gained about 150. And what I want to go over now, speaking of the S&P, from my last video on this topic, I discussed the UPRO fund, which I got a pretty significant stake in to start the year. Now, this fund, this is leveraged to do triple times the S&P. So we're off to a really great start on this because if the S&P goes up 5%, this is going to do 15%. If the S&P goes up 20%, this is going to do 60, and so on and so forth. So from the first trading day of the year, we're already up $4 in this fund, which is phenomenal. So if we do some quick math on that, that was 4 divided by 32, 36. So we're up 12% already, which should be, that means the S&P is up about 4% for the year. Let's check that because you should be able to just divide by 3. So S&P, yeah, 4.16% in the S&P, easier on the iPhone. NASDAQ's up 6%. And I know we just went over this, but I didn't give the percentages. The Dow's up 3.18%. So the Nasdaq's actually kicking butt to start the year. And if you go from January 5th, it was almost 7% because we had a little bit of a drop on the 5th. So this all is only like 7 or 8 days ago. Anyway, with all of that being said, so yeah, the UPRO fund's doing tremendously well. Now, this is not one that you hold for the dividend, but obviously the ones that are dividend heavy, we're going to get into in just a minute. So just hold your patience on that because it's coming. Of course, Yahoo has to be a bit glitchy on me as usual. So you see what this thing does? Like as soon as I click this, it tries to go to options. By the way, UPRO is optionable. So keep that in mind. Okay, I'm looking for dividends only. I'm just going to show the dividend real quick. You don't hold this for the dividend. You can see this only pays twice a year and it's very minimal, very minimal payout. Now, let's go to our favorite ones. JEPQ actually snuck in a dividend at the end of December, and that deposited in the holders' accounts last week. So that was kind of nice because I actually got a bigger stake in the JEPQ. So I got a nice dividend check last week, which I was kind of surprised. I was like, wow, just bought it and got the dividend. That's kind of cool. So this fund is doing quite nicely. We're up, if you look at the after hours trading, 42.58. So we're up almost $2 for this fund. And if you had pared down and bought on the 5th, which when it was $40.24, it's 42.14 today. You would be up almost $2 based on 40.24. That's a 4.7% gain. And yield is holding steady at 15.89%. Now, as the NASDAQ starts to recover, I believe this fund will recover. Uh, and we'll see what impact that has on the dividend because remember, this is a covered call ETF. So we'll see how this goes. Typically, I believe the fluctuation in the NASDAQ uh, has a big influence on this because the way covered calls work, when you're selling covered calls to generate premium, if the strike price is never reached, they just expire worthless. You keep the premium. So when the Nasdaq's going up, these premiums, it's going to kind of work inversely. The premiums are going to go higher, and then you may have to, if you're just doing these covered calls as an individual based on the Nasdaq, you would then have to either buy back at a higher price or roll the trade. Now, granted, these fund managers are professionals, so they are probably a bit better than you and me when it comes to this. But that's the idea behind covered calls. So the jury's still out on how this dividend will remain. But the good news is this fund should appreciate in value along with the Nasdaq. And for the time being, we seem to be having our cake and eating it too because we're getting nice dividends and the fund is going up in value. Now let's go to historical. So we got a nice 57.6 dividend yield or 0.576 dividend yield just with 2 days left to go in the year. So that deposited just last week, which is quite nice to start the year off with something like that. Now, QYLD, which I haven't been talking about as much, but I'm going to go over here because this one also snuck in a dividend right at the end of the year, which was also dispersed last week as well. This dividend dropped a little bit, but not too much, as I'm going to show you here. So if I go to dividends only, and yeah, December 29th, with 2 days left to go in the year, it paid a 16.1 cent dividend, which was a little bit lower than the one from November and October and September. Oh, and actually, this was the lowest one of the year. Uh-oh, time to sell. No, I'm just kidding. It wasn't that much lower than the December. But see, the thing is, we could see these dividend yields drop if the fund starts to appreciate in value. Now, let's do a quick appraisal of how the fund is doing so far in the year 2023, which seems to be off to a decent start. QYLD is, let's see, come on, Yahoo. It's up slightly. Wait, that's just one day. No, we're up. We're up almost $1 or like 70 cents, 15.83. We bought it out at 15.75. So yeah, we're up like 70 cents or so. The yield's showing 13.74. So the trailing yield is actually pretty good still. And now let's look at SVOL. This is quickly becoming a fan favorite of mine. And by the way, I'm not talking about any cryptocurrency tonight. I posted a fully edited video last Saturday, and it got like no views at all. So, and I pay for those, so that's kind of not fun, because you pay for a video, you get a few cents in ad revenue. Not a very good ROI, right? And me being a financial person, that's not so great. But obviously, my niche on this channel is these funds. These are the main things that get views. So, got to stick to that. So the Simplify Volatility Premium ETF, SVOL, is trading at $22.54, which you'll notice for those keen observers is about half the cost of the JEPQ. So you could get, look at this now, a better dividend yield for half the cost. Win-win, right? But there's a few catches to this that there's reasons why I think you would want to hold both, or I want to hold both. And if you want to be like me, I guess you want to hold both. deductive reasoning, right? I want to hold both. You want to be like me, so you hold both. So since the start of the year, we are up about same as the QYLD, about 70 cents or so, give or take. And then historical data, let's look at the last dividends. Now, I believe this one pays quarterly. Still have a little bit of a cough. I was sick like 2 weeks ago, but still lingers. Either that or I just get choked up when I talk about these awesome dividends. Maybe that's what it is. Dividends only. Now, volatility is something I'm going to talk about also towards the end of this video, bonus content, because I got a commenter, very astute commenter, I might add, pointed out that I didn't explain what the VIX was. So I'm going to explain that in this video. And no, it's not VIX Vapor Rub. And no, they don't sponsor me. And I don't have any sponsors still. I had one, but they seem to kind of be a joke. And there's that colorful Fidelity ad again. Let's see if we can X that crap out. Thumb it down. Oh, and it's going to do this. This is annoying. It tortures me. Okay, it's gone for now. Okay, so actually, I was wrong, if you can believe that. This fund does pay monthly, 34 or 0.349, which was higher than November, October, September, August, July, May. They missed June. How dare they? They missed a month. Let's see now. January, February, March, April, May. Yeah, they missed June, but they hit July, August, September, October, November. I wonder why. If anyone knows why in the comment section, because I know you all that watch this, you know way more about these funds than I probably do. So I'm really honored that you watch me and take notes on me, because a lot of you know more about these funds than I do. So if one of you knows why they missed the June payment, feel free to comment on that. So what this fund does, this fund tries to make a return based on volatility in the market, which is measured by the VIX index. Now, you can trade the VIX index, which I'm going to show you next, but I just want to go over the performance of this fund, because the appeal to this fund is that as the market is more volatile, you can take advantage of the volatility, essentially. That's at a high level. And you see how 2022 worked. You see we were kind of up and down, up and down. The trend overall was down, if we were to draw a trend line. But you can see there was choppiness. We were up and down, up and down. This has a 0.66% expense ratio. I thought I would point that out because it happens to be right there in front of me. And let's just read through this again, which I know I've read through before. In pursuing its investment objective, the fund primarily purchases or sells futures contracts, call options, and put options on VIX futures. The fund will hold cash, cash-like instruments, or high-quality short-term fixed income securities. Up to 20% of the fund's net assets will be subject to the fund's option overlay to mitigate against extreme volatility. So that's how that works, and it does futures too, which is also something I want to learn. One of my many 2023 New Year's resolutions, in addition to putting out a book in September, which I want to believe I'm still on schedule for. So we'll see how that goes. If I can keep this channel growing and get other ones going. So, okay, so that's SVOL. Now we're going to go into the VIX here. We're kind of in bonus content here. We're going to discuss, if I can type, we're going to discuss the VIX. Okay, the CBOE volatility index. So this is the Chicago options exchange, basically. The CBOE, Chicago Options Exchange. This is how Yahoo is showing the VIX. So you can trade the VIX, and it is optionable as well. Now, it seems that volatility is dropping so far in the year 2023, because you can see the VIX has gone down from 2346 to 1883. And you see the choppiness here, because 2022 was obviously a very volatile year. And if we go back like 5 years, you can see the VIX actually, when do you think it peaked out? When the pandemic started, March 2020. That's when the market was the most volatile that it's been in the last 5-year period. You'll notice the points of the highest volatility you're going to see coincide with the most precarious times of economic uncertainty. Like you'll see, this is obviously 08. You could look at it and guess. If you're really into the stuff, you can guess. Obviously, there's the pandemic. This was in 2011 when the debt ceiling stuff was going on with Congress, which we may get into that again because any of you that follow that, we now the new Congress seems to have found their inner deficit hawks again. Comes around every so many years, but it's been basically out of existence for the last few years. Oh, there's that Fidelity Metaverse ETF. They gave me a better ad. So that's November 2008. This is, you're going to see the '02, the economy was bad in '02. What's this one here? This is the dot-com boom and bust. So yeah, basically all the spikes in volatility coincide um, with a very volatile economic time when there's a lot of trading going on. So that's the VIX. It's optionable. Now, those of you that know options, of the components of option price, volatility is a key one, and that's why there's a school of options traders. A lot of them, especially professional ones, will not trade earnings because the volatility spikes before earnings. I disagree with that. Like in my own experience, it's one of those things that's worked well enough for me that I'll continue to do it. But what I say is that you would trade right before, like a couple weeks before, but not right before. You would want to own the option, or maybe even do a leap option where you have like 3 or 4 earnings periods within that same time frame. Now, for me, tomorrow, I know J.P. Morgan options are got ahead of myself there, Freudian slip. I know that J.P. Morgan earnings are coming out tomorrow, so I didn't do this, but I would have thought, to take a gander at JP Morgan options and pick a decent strike price that I like, because if I had to flip a coin, I would say they're going to beat earnings tomorrow. They may miss earnings, but when you do something like that, you're really making a gamble on the stock making a rapid move upward. And when you get into the Wall Street bets crowd, that's where, they're actually taking the extreme. They're looking at options that are way out of the money that are cheap and looking for like the YOLO, like hitting the jackpot trade. And it's just like, in baseball, you're not going to hit home runs or grand slams all the time. They do happen, but you can't base your whole playbook and strategy on the grand slam, so to speak. So that's the VIX. Now, let me go to Google and we'll just look over some, brief uh, VIX index. I just want to pull up so I do a decent job explaining it. VIX is the ticker symbol and the popular name for the Chicago Board Options Exchange CBOE volatility. I knew the B stood for board. Uh, Popular measure of the stock market's expectation of volatility based on S&P 500 index options. So that's the VIX in a nutshell. I'm going to pull up the Wikipedia article. And of course, we could all pull this up and read it ourselves, but it's easier just to listen to me talk. And I'd rather you do that because it helps my watch time, of course. So, that's the motivation there. So yeah, VIX is the ticker symbol, popular name CBOE, like I said. The VIX traces its origin to the financial economics research of, oh, look at this, Menachem Brenner. Did I get that right the first time? And Dan Galai. In a series of papers beginning in 1989, Brenner and Galai proposed the creation of a series of volatility indices, beginning with an index on stock market volatility and moving to interest rate and foreign exchange rate volatility. In their papers, Brenner and Galai proposed the volatility index to be named Sigma Index would be updated frequently and used as the underlying asset for futures and options. A volatility index would play the same role as the market index plays for options and futures on the index. In 1992, the CBOE hired consultant Bob Whaley to calculate values for stock market volatility based on this theoretical work. Whaley used data series in the index options market and provided the CBOE with computations for daily VIX levels from January 1986 to May 1992. Fascinating. I've never actually read this article myself, so I learned a little bit there. But essentially, that's what the VIX index is. Hopefully, I explained that decently. If you like that, please remember to like, comment, and subscribe. It looks like it's still on that screen. You know what? Let's make it an even 20 minutes for fun. We've already gone this long. So VIX index, this is from 2004 to 2020. Let's see what else this article says here. Specifications. The concept of computing implied volatility or an implied volatility index dates back to the publication of the Black and Scholes 1973 paper. Now, Black and Scholes has to do with options valuation, and that formula is going to be down here. I actually had this in a finance class. It's crazy. I've forgotten it. I believe it's on the CFA exam. But yeah, that has to do with options valuation. Here's the formula here for any of you that are math nerds. VIX is the square root of this and this. This is a little bit of calculus equations here. There's the infinity symbol. Yeah, I had this, like I said, in finance. Oh, here you go. The VIX is a 30-day expectations volatility given by a weighted portfolio of out-of-the-money European options on the S&P 500. I don't know why they got to be European. We're in America after all. Where R is the number of average days in a month, R is the risk-free rate. That's right. F is the 30-day forward price on the S&P 500, and PK and CK are prices for puts and calls with strike K and 30 days to maturity. I kind of want to go back into this now because I did learn this, but you never fully master something the first time. And remember this, and I'll leave you all on this note. There's something called the 3-21 rule or 21-3. When you're learning something new, okay, it goes something like this. The first 21 days, or something like this, you only retain 3% of something new that you learn, or you may retain all of it the first day, but you lose 3% a day. And over 21 days, something like you may end up losing most of it to where you only remember 3% of it. But you basically have to be exposed to the same idea all 21 days, not just all 21 days, but you basically have to be exposed to the idea every day. You have to constantly keep reintroducing, reinforcing the idea for it to stick. Otherwise, you're only going to retain like 3% of it at a time or something like that. So remember that the 21-3 or 3-21 rule. You know what? We can Google that real quick. 3-21 rule. Yeah, it's not going to show. Wait for memorization. Okay, forget it. But that's the gist of it. So hopefully that was valuable to you all. The 3-21 rule, that's, a reason why you all should watch my videos over and over, of course, because it takes repetition to remember this stuff. If you like that, please remember to like, comment, and subscribe. Thanks so much for tuning in. Keep an eye out for my next videos, and take care.